Five stocks to buy in 2024. Year to date in 2023, the S&P 500 is up close to 23%. The QQQ ETF, which tracks the Nasdaq, is up over 54%. So the real question is, will these gains continue on in 2024? And really where I am looking to be positioned in the upcoming new year. We'll dive into the five stocks I'm looking to get into in 2024 and my thesis around all of them. We have a long video for you guys here today, so sit back, relax, enjoy, and if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. I see a lot of you guys watching the videos are not subscribed, and we're on our way to 1,000 subscribers. Your support would mean a lot, and I hope to bring value to you guys from these videos, so be sure to hit that like and subscribe button below. Let's jump right into the first of these five stocks, that being Amazon.com, ticker symbol AMZN. Year to date, the stock is up nearly 80%, but I think it's still positioned in a really strong way heading into 2024. I think this is a company that, frankly, is just one of the best run businesses in the world, and we'll get into that and a lot more. The first reason being Amazon is sticking ads in your Prime Video shows and movies unless you pay more. So Amazon aims to show meaningfully fewer ads than traditional TV and rival streaming platforms. An ad-free option will be available for an additional $3 per month. So back in the end of September, this was the end of September, Amazon announced plans to start limited advertisements in its TV shows and movies running on the Prime Video streaming platform. That will allow the company to continue investing in compelling content. That's just another way of saying, yeah, bring more profits down to the bottom line for Amazon. They said the ads will first be introduced on Prime Video in the US, UK, Germany, and Canada, and that will happen in early 2024, and then later on we'll move on to other countries in the Europe and Australia. And it says Amazon doesn't plan to change current price of its Prime memberships in 2024, and then Prime members will be notified of this change several weeks before the ads go live. And so the ad-free subscription is really an additional of $3 per month on top of the existing US $15 a month, or $139 per year if you pay annually. And I think what this will do really is just a lot of these $3 per month additions will flow right down to the bottom line. I think in 2023, Netflix and Disney really paved the way to show Amazon that, yeah, having an ad-free subscription model really does tend to work on these streaming platforms. They naturally introduce a little bit of churn when introducing these new ad-free subscription models. Some people will cancel their Amazon altogether or stay on this lower ad tier business of $15 per month. But I think the majority of people actually do tend to upgrade onto that ad-free platform. And so what that'll mean for Amazon and their Prime Video customers is, yeah, this $3 a month will really just flow down a lot of it to their bottom line. And the beneficial thing for Amazon is that if people continue to choose to stay on this ad tier subscription of $15 a month, yeah, Amazon has a very large and very rapidly growing advertising business. And so they can likely serve ads from their own products onto Prime Video customers. And so even if customers choose to not pay the additional $3 a month, they'll likely see a boost in terms of e-commerce sales just from advertising their own products. And so regardless, it seems like a win-win for Amazon, whether people choose to sign up for that ad tier business or stay on their existing plan. And I think, like I said, Netflix really paved the way and showed that this can be successful for streaming services as a whole. There's really no question that this will likely be pretty profitable over at Amazon. Now, speaking of advertising, ad spending is likely to grow in 2024 based on Morgan Stanley's outlook. So their outlook for advertising in 2024, they expect US online advertising growth to accelerate to about 12.5% in 2024. In 2023, it's at roughly 8%. At a high level, the analysts continue to expect performance-based advertising and leading, targeting relevancy conversion to drive e-commerce sales and ad dollars to follow transactions. So again, advertising over at Amazon really just helps themselves in a ton of ways, primarily through their e-commerce business. Now, analysts also see the introduction of ads for Prime Video as an incremental lever to steer online ad growth in 2024. They have sized Prime Video US ad opportunity to be roughly $5 billion by 2025. And so look, while you might say $5 billion for a company that's worth over a $1.5 trillion, not a huge thing. Keep in mind, a lot of these ad dollars flow right back to Amazon's bottom line. They can really drive profitability through opportunities like this in a rapid way. And then the other thing they say is Prime Video shifting its viewers to an ad-supported service in the US, combined with its already advertising large-scale service capabilities, will have a bigger impact on the existing CTV players in 2024 than Netflix and Disney had upon their launch in 2023. And so this analyst over at Morgan Stanley also see that Amazon moving towards more ad-tier business on Prime Video will have a bigger impact than Netflix and Disney. Certainly with Amazon, I think it's often easy to forget about their advertising arm considering how big e-commerce and AWS is, but advertising is frankly one of their fastest growing segments, and one of the reasons why I'm so bullish on this company in really the next few years. Now, Amazon is also at war with literally everyone. They compete in pretty much every space. You obviously know of Amazon.com competing against e-commerce giants like an eBay, even a Flipkart in India, which is actually owned majority by a Walmart. But you have Amazon.com competing against that. Obviously, you have AWS in that cloud storage. And look, you still have Google Cloud, you still have Azure. And I'm not saying AWS is the only cloud storage that will see growth. I'm sure Azure and Google Cloud will continue to see growth in 2024. I just like Amazon because they frankly have such a diverse portfolio. They're also in Twitch, which honestly is a pretty good growth engine, I think, heading into 2025, considering the new GTA will be launched then. I think a lot of streamers and content creators on Twitch will look in 2024 to capitalize on that GTA 6 hype. And again, they have the majority market share in the game streaming industry. But again, they'll continue to take that from YouTube gaming. I think 2025 for Twitch should be frankly a phenomenal year. Now, they are also in wallets and payments with Amazon Pay, again, competing against a Google Pay, a Paytm in India, even like a PayPal. Amazon Logistics is frankly a massive segment that they have competing against FedEx and UPS. And I read the statistic that Amazon is planning to deliver more packages in this quarter than a FedEx and UPS. And that is just a staggering statistic considering these are multi-$100 billion companies on their own. And so if you were to take Amazon Logistics on its own as a standalone company, it's likely worth a hell of a lot more than it is packed together within Amazon, where it's frankly not being realized to its full potential, in my opinion. You also have smart speaker with Amazon Alexa taking majority of that market share, Prime Music competing against something like a Spotify, and then, as we mentioned, Amazon Prime Video competing against a Netflix. Along with this, you have a Whole Foods business competing in grocery. You also have Amazon pushing into healthcare, competing with companies like a CVS and Walgreens. And so this is just scratching the surface over what Amazon is doing. They'll likely continue to be a market leader in majority of these spaces. Really over the next few years, their market dominance will continue to grow, and along with that, their earnings will continue to grow. In 2024, their earnings expectations to grow are close to 30%. Now, on a forward priced earnings at 44.5 times on a forward priced earnings basis certainly does look expensive, but keep in mind, they're looking to accelerate that growth into 2025, where they expect to grow close to 35%. And then top line growth is expected to be in that low double digits for really the next 4 to 5 years, you can call it. And so while a 44.5 times price to earnings multiple does seem expensive, this is a company that frankly has traded at a far higher multiple for a long time. And I'm sure will trade at a pretty steep multiple in the near future. You're getting a very strong earnings growth company that likely will see, again, continued benefits from things like an ad tier business on their Prime Video that's probably not recognized into their earnings fully at this point. And so likely this forward priced earnings is probably closer to a 42, maybe even a 40 times. And so at that price, I think that is a fair value for Amazon. I think you can expect to pay a premium on this stock compared to the market. Certainly you're not picking up this stock for 20, 25 times earnings, at least not in the next foreseeable future, while they're still able to grow their earnings at such a rapid clip. Now, moving on to the technicals for Amazon, this one has really been consolidating over the past, you can call it 4 years. It's basically in the same level where it was back in 2020, and now has broken over a key level of resistance at $144 per share. It is looking to break out in the very short term, does seem to be making a pretty steep uptrend, so you can expect maybe a back test closer to $144. But again, that is in the short term. For the next 1 year, I think Amazon is in a great position to continue this upwards trajectory. I think this one is headed back to the $180 really in the next 1 to 2 years. And that's pretty much if everything goes as expected. If they end up surpassing analyst expectations. Yeah, this stock has likely a lot of room to the upside if it can break through above this range of consolidation, above really $180 a share. This one really has clear skies to run. I think Amazon can be bought on really any major dips heading into 2024, even throughout 2024. This is a company that is positioned in a really strong way. That was stock number 1 of 5 I'm looking to buy in 2024. Moving on to number 2 out of 5 stocks, that being Nike, ticker symbol NKE. This one is up just 3% year to date, and over the past 1 year, up close to 19%. So Nike, one of your most recognizable brands in the world, just a very high quality company that really knows how to execute year in and year out. You're getting a 1.2% forward yield on this, trading at a price to earnings closer to 32.5 times. But I do want to point this out. We stretch it back over the last 16 quarters, back to November of 2020. Over the last 16 quarters, Nike has only missed earnings 2 times. First one being in May of 2020, where basically the entire global economy shut down. And then the second time being in May of 2023, where they missed by 1 cent. Every single other quarter over the past 16 quarters, they have not just beat their earnings estimates, but beat them in a substantial way. You see, they beat estimates by roughly 25%, 45%, 30%, 23%, 20%. Nike just comes in with these beats on that earnings side, really quarter in and quarter out. And so really, when you see that their forward price to earnings is closer to 32.5 times, that's also for the fiscal period ending May. So really for the next 12 months, their forward price to earnings closer to 30 times. And then keep in mind, they're consistently beating earnings. Likely they'll come in with beats again. And so your forward price to earnings on Nike is probably sub $30 for 2025. That, I think, for a company that's, again, looking similar to an Amazon, looking to accelerate earnings growth into May of 2025. And then Nike is also looking to accelerate revenue growth in 2025. This is a company that just executes very, very well year in, year out. And you can expect that mid-teen earnings growth. And again, similar to an Amazon, this company always trades at a premium, but I think quality in the market certainly deserves a premium. Now, along with earnings growth, you can also expect a very steady dividend growth over at Nike. You see over the last, you can want to call it 5 years, 10 years, Nike has been growing their annual payout by roughly 10 to 12% every single year. And so you can expect nearly a 10.5% bump on those dividends. And so that really allows you to hold these shares for a long time, bring down your cost to yield over time. And then with those dividends reinvested, you'll likely be doing quite well from a capital and dividend appreciation on shares of Nike. This one has raised its dividend for really, I think, over the last 20 years. And so certainly that dividend is safe and you can expect another dividend bump. Now, moving on to Nike's technicals, this you can stretch it back all the way to 2012 and it has been locked in an uptrend. And back in 2015, you could have said Nike is overvalued considering how far it was from its upward trend line. And then it continued to just rally throughout the year. So keep in mind, this is a stock that on any major pullback, I think you can come in here and acquire, especially closer to the $100 a share. This is like I said, a quality company with terrific pricing power. As you move in 2024 with lower interest rates, I think consumer discretionary items will once again be back in favor. And I think Nike certainly benefits from that trend where your consumers have a little more dollars in their pocket that they're willing to spend on discretionary items, such as a Nike shoe or some Nike apparel. And so I think Nike over the next 1 year, but especially over the next 2 years, 2 to 5 years, is really in a good position and can be a consistent buy and hold in your portfolio. That was stock number 2 of 5 that I'm looking to buy in 2024. Moving on to number 3. This one might surprise a few of you as it's a stock we've never talked about on this channel before. Stock number 3 is PepsiCo, ticker symbol PEP. Yeah, this is a company we've actually never spoken about on this channel, but I frankly, honestly love what PepsiCo has done with their business over the last few years. They've gone out and done, frankly, a ton of acquisitions, which has honestly allowed them to continue to gain market share and really stay at the top in the food and beverage space. Year to date, this stock is down close to 6.5%, and over the past 1 year, down nearly 7.5%. Now, with Pepsi, you do get a forward yield of close to 3%. Over the past year, with shares declining, your yield has actually gone up. And so you're getting a 3% forward yield on this, trading at a price to earnings on a forward basis, close to 22.5 times. Certainly not overly expensive. Actually, if you look at it for calendar year 2024, your forward priced earnings is closer to a 21 times. Now, they are expected to grow in that really mid to high single digits, close to 8% on that earnings side. And then on that revenue side, expect mid single digit growth. But I think where Pepsi really shines through is it's just really a consistent company that's honestly trading at a pretty fair price, in my opinion, at a 21 times forward price to earnings. I think that's fair to pay for a PepsiCo, considering the strength in the brand you're getting. Similar to a Nike, you're also getting very strong dividend growth on this company. Not as strong as a Nike, but you're getting consistent growth of roughly anywhere between 5 to 7% on your dividends. One of those dividend aristocrats, you can expect that dividend bump really year in and year out. Similar to an Amazon, Pepsi has a ton of brands. Frankly, if you're walking down the grocery aisle, you'll probably interact with one of these brands. At one point or another, you have your Pepsi soda, and then you also have your Frito-Lay snack business. Along with that, you have Gatorade, Tropicana, Quaker Oats, Tostitos, Doritos, Mountain Dews, Cheetos, and a ton of other businesses. They're also in the bottled water space, owning Aquafina. And so really anything relating to snacks, food, and beverages, yeah, chances are it's probably owned by PepsiCo. Now, I have their cash flows for the last 9 months pulled up just to show you that this company does generate a ton of free cash flow. You see, even though earnings, their net income did decline on a year-over-year basis in this most recent quarter, they were still able to grow on that operating cash flows pretty substantially, as they posted operating cash flows of close to $7.6 billion. Last year, we were close to $6.3 billion. And so with that strong cash flow, really allows them to do is repay some of their debt, but more importantly, pay off dividends and then repurchase a small amount of shares. And really any excess cash flows they can add onto their balance sheet as cash in order to complete acquisitions down the road, or again, pay off or refinance debt. This is a company that frankly is just positioned in a very consistent and predictable manner. I think you can expect your steady dividends. Getting a 3% yield on Pepsi is, in my opinion, frankly, a blessing. You'll likely see a rotation once again into dividend paying aristocrats, considering interest rates will likely begin to lower, and so your high yield savings accounts won't likely yield 5% anymore starting next year. And so you'll likely see another rotation back into these dividend payers, and I think Pepsi is well positioned for that. Now, similar to a Nike, this one has been in a long uptrend. We can go back to 2009, and it's basically been in a consistent uptrend of higher lows and higher highs. Now, it is quite a ways away from this uptrend, but I think in the shorter term, you can almost sort of make another uptrend, a bit more steep, dating back to 2018. And it seems like it has recently just bounced off that. And so really, even if it does tend to break this upper trend line, I think any major decline in PepsiCo is really honestly a buying opportunity. Your yield will likely go higher than 3%. And then any shares that had lower, Pepsi will likely step in and look to buy those shares back. A very strong company. I think you know what you get when you buy shares of PepsiCo. That was stock number 3 of 5. Now moving on to stock number 4. This is another mega cap. You can likely guess what it is if you've been watching the channel. Meta Platforms is stock number 4 of 5 that I'm looking to buy in 2024. Now, what might surprise you is, yeah, the stock is up over 200% over the past 1 year, up over 180%. And I'm still saying I'm looking to buy the stock in 2024. That's because even with these gains, the stock is still, in my opinion, far, far too undervalued. Now, Dan Ives from Wedbush Securities did make a bullish statement, actually today, this came out December 19th, that for his wish list in 2024, he expects tech stocks are set up for a AI spending tidal wave, and he expects Apple to hit a $4 trillion market cap next year, and then Microsoft to follow that, hit a $4 trillion market cap in early 2025. And then he also expects tech stocks that are already up 25% in 2023 to be up another 25% in 2024. And then that the Magnificent Seven, that being your large cap tech names, those he expects to be up nearly 30% with AI front and center. And so certainly he is very bullish on tech in 2024. And I think a lot of analysts on Wall Street and really people are bullish on tech, considering that the AI wave is just beginning. And I think that spend in AI will continue to ramp in 2024. Now, that's actually not my biggest reason to be bullish on Meta. Frankly, it's just the valuation. This one is still trading underneath a 20 times forward price earnings, with earnings growth expectations at nearly 21%. Frankly, again, this company just has no business trading at nearly a 20 times price earnings when it's expected to grow close to 21% on that bottom line. And then similar to an Amazon on that top line, expected to grow in that low to mid double digits percentage. Really, this is a company that will benefit from the tailwinds of advertising dollars in 2024. Along with that, of course, AI will have a part to play. And then the cost efficiencies that they've made in their business, I think that is expected to stay. We see expenses as a percentage of revenue. This is something Meta has really right-sized over in 2023, which is frankly why the stock has been rewarded so heavily. In 2022, you see your expenses as a percent of revenue was steadily increasing, and then with all the cost cuts that went into this year for Meta, they have really right-sized expenses over at the company. You see from their last earnings call, this is their third quarter financial highlights. Revenues were up nearly 23%, and then costs and expenses were down 7%. And so your income from operations up 143%, and then your net income up close to 164%. Certainly, that is very bullish to see over at Meta. The only thing that has me concerned for this stock is, again, operating loss over at the reality lab segment. This is a segment where Meta expects to continue to lose more money in the subsequent few quarters. I believe in the next fiscal years, Meta expects reality labs operating losses to increase meaningfully year over year due to the ongoing product development efforts in augmented reality and virtual reality. And so that's the only thing that has me concerned, is that these operating losses will continue to meaningfully grow. The only reason I'm willing to overlook that is because their family of apps, operating income, and revenues have consistently been getting stronger. And so I think that's one reason why investors are willing to give Meta a pass on this reality lab segment, is that because their family of apps has been so strong, their operating margins has actually continued to increase from a 2 years ago basis. That is what's driving the shares forward. And certainly if that advertising business on that family of apps slows down, that will certainly hurt the stock price. Now, speaking of the stock price, this is basically in the same place where it was 2 years ago. So 2022, it had a massive sell-off. And then I think a large part of 2023 was just correcting back to the mean. And in all honesty, I think this company really fixed its operating expenses over the past 1 year. And so when you see the stock being up nearly 200% over the past 1 year, you would frankly expect it to be expensive. But the reason it's not expensive is because it's pretty much the same place it was 2 years ago. Frankly, this extreme sell-off that occurred in Meta in 2022 really shouldn't have gone this far. But again, that was an opportunity back then. I think Meta is still an opportunity heading into 2024. Really, they're positioned in a strong way. This is now broken out of this upper trending channel, but is making another uptrend just underneath, closer to $340 a share. And so I think you can look to pick up Meta really on any major dip heading into 2024. And then within 2024, again, any major dip in Meta, my opinion, can be comfortably acquired, considering that the valuation for this company is frankly closer to a 20 times next year. And then really any meaningful sell-off will push this price to earnings further lower. That, in my opinion, is a very good discount for shares of Meta over the long term. I think this company will see benefits from AI, certainly on that advertising side. And then if they can continue to maybe down the road pull this operating loss together, that would be extremely bullish over at Meta. This is sort of a wild card that is just a cherry on top. Really, I'm so bullish on this stock just based on their family of apps advertising business. And that is what is keeping me in shares of Meta. That was stock number 4 of 5. Moving on to the last stock I'm looking to buy in 2024. If you are a longtime viewer of the channel, you probably would be able to guess it. It is PayPal Holdings, ticker symbol PYPL. Over the past 1 year, down nearly 8.5% year to date, significantly underperforming really anything, down close to 15.5%. Now, I've made videos on PayPal and why I'm so bullish on this stock, and it really just comes down to the story more so than the financials and the fundamentals, and we've covered those in depth in previous videos. Now, before we get into why I'm so bullish on it, I do want to cover a story that is actually bearish on PayPal, And although I'm bullish on the stock, I think it's important to take a look at every story that comes out and really analyze it from an objective view. And so Amazon is to stop accepting Venmo as a payment option from January 10th, 2024. And so after Jan 10th, 2024, Venmo won't be accepted as a digital wallet on Amazon.com. And this was announced back in just over 2 weeks ago. Certainly this is important over at PayPal because PayPal does own Venmo. And so due to recent changes, Venmo can no longer be added as a payment method, but Venmo will be still available for users who currently have it enabled until 10th of January. And so Venmo debit and credit cards can still be used even after the stoppage comes into play, but the instant payment service itself will be disabled. And certainly that is actually bearish for Venmo, considering Venmo is one of the best growth engines for PayPal. But one thing I do want to point out why, in my opinion, I think this is not that big of a deal is because the Venmo and Amazon integration didn't roll out until October 2022. And so although there was an option that Venmo could be moved beyond P2P payments and grow its revenue through transaction fees, that actually didn't occur until October 2022. And really, it only had a year to play out. And in that time, I think Venmo really wasn't seeing any benefit from this partnership. And so they decided to pull the plug on this integration. Probably a good thing that, honestly, the new CEO, Alex Chris, has done fairly quickly, considering that they probably weren't seeing any benefit on that Venmo side. They did say we have a strong relationship with Amazon and look forward to continue to build on it. So certainly you can still pay with PayPal, I believe, and you can still use Venmo credit and debit. It's just you can't use Venmo's instant payment service, which is basically like a cash balance, which as a consumer honestly makes sense. I would much rather use a credit card where I can earn rewards and cashbacks on my Amazon payments rather than using pretty much an instant payment service. And so although this is bearish for Venmo, I think not that big of a deal when you really break it down. Now, what is a big deal in my opinion is PayPal ramping up new features to compete with Apple Pay and Stripe. And so teams across PayPal are rushing to add new features to make its digital wallet online checkout more appealing to shoppers and merchants. And so the new CEO, Alex Chris, is ramping up efforts to defend against competitors such as Stripe and Apple in a project codenamed Quantum Leap. And so right away, we have another sign that the new CEO and new management is really coming in and taking charge. And so the initiative aims to mark meaningful progress by Jan, with the aim to roll out changes as early as March. And the product is seeking to boost growth and profits by getting more shoppers and merchants to use PayPal products, which are more profitable than the company's Braintree products. And then that improves the checkout experience and was named the top enterprise priority in this document. So again, I think this is quite a bullish story. You have a new management, a new CEO, and right away you see two signs of them taking charge and cleaning up some things. They stopped the Venmo integration on Amazon, and then again, they're having this project code named Quantum Leap to roll out new features in order to make it more competitive against its competitors. Again, I think quite a bullish story and just another sign that Wall Street just has to take some time to trust this management team. In terms of their operating and financial metrics, really across the board, payment volume, revenues, operating income, EPS, everything was up on a year-over-year basis. So really, he's not fixing what's initially wrong at the company. The company is still continuing to operate just fine. He just has to clean up a few things in terms of operating efficiencies. Certainly, that is looking to happen over at PayPal. Now, just frankly, the valuation for this company is, in my opinion, just silly. It has stayed like this for a long time. We've mentioned this on the channel before, trading at a forward price earnings under 11 times for a company that's expected to grow roughly 12.5% next year, expected to grow in that low double digits for the foreseeable future. And then on that revenue side, expected to grow in the high single digits. Again, an 11 times forward priced earnings for a company like this, I think, is far too cheap. It's something Wall Street, in my opinion, will come around to recognize maybe in 2024. Maybe 2024 is the year for PayPal. We just have to wait and see. I think you're getting the stock at a great price and not sure how much longer it'll stay just like that. From a technical perspective, this one has been locked in a downtrending channel for really over the past 2 years. It is looking like it is wanting to break out from a technical perspective from this channel. I wouldn't really confirm this as a breakout until really it comes up here over $74, $75 a share. comes back and retests this channel at roughly, call it $60 a share even, and then continues to make a move higher. You want to see a streak of higher highs and higher lows for PayPal in order to really confirm that this has broken out from just a technical perspective. Fundamentally, we saw this company is looking very strong. Valuation is very cheap. But again, from a technical perspective, you want to see a confirmation of a breakout. That's usually done by a back test to that previous range and then a further move higher. So it looks like this is what PayPal is wanting to do. I wouldn't confirm it until it makes a sort of pattern like this. Until then, I think from a long-term perspective, you can still come in here and acquire these shares just from a purely fundamental and valuation perspective. That was stock number 5 that I am bullish on in 2024. Certainly 2023 has been a great year, especially if you are really in overweight any tech, and you're likely now overweight a lot of tech names considering how much they've rallied this year. But I think you can continue to pick up shares of high quality companies like an Amazon, like a PayPal, that are still part of that tech rally, but I think trading at a reasonable valuation compared to their earnings expectations. And then you have staples like a Nike, like a Pepsi, that really have pricing power, that have very strong brands, very reputable brands. And again, consumers that are now likely to be more willing to spend on discretionary items, even on that food and beverages side, likely able to spend a bit more on name brands. And then you have a company like PayPal, which is still a dominant leader in the payment processing space. Sure, they have competition, but they're still continuing to grow their fundamentals, improve their financials, and frankly, trading at a very discounted level compared to the overall market. And so in 2024, you have some tailwinds with, of course, lower inflation, with lower rates, and really the expectations of lower rates. Certainly, this is not something that's confirmed, but I think the market is pricing in substantial rate cuts from the Fed in 2024, and certainly that is proving to be a tailwind heading into next year. You certainly do also have headwinds, though, and so are we heading into 2024 with too much optimism? Possibly if these rate cuts don't come in or interest rates stay higher for longer, certainly that can prove to be a headwind, maybe first half of 2024. And then in the second half, you have an election year, so certainly the news will turn from fundamentals and financials to more stories related to the election that will happen later on in 2024. And so at that point, it'll be important to continue to remember that fundamentals and financials are really what moves companies over the long period of term. In the short term, in 2024, you can absolutely see some volatility based on these headwinds. But I think in the long term, they will once again come back to all the metrics really we covered on in this video. And I think the important thing to remember is you want to have a well-balanced portfolio. At least I want to go into 2024 and continue to buy stocks in 2024 that will allow me to have a well-balanced portfolio. Certainly, it's easy to be overweight tech in an environment where the Nasdaq is up over 50%. And so you continue to position yourself into names like a Pepsi, like a Nike, that really have strong brand appeal with consistent dividend and capital growth. That was 5 stocks I'm looking to buy in 2024. Let me know your thoughts on this list, whether you agree, disagree, and comment down what 5 names you are looking to buy into in 2024. As always, thanks so much for listening, and I'll catch you guys in the next video.